In one corner, a wrestling company that just posted almost $500 million in a single quarter. In the other, a rival that's making more money than it ever has in its history, while its TV ratings are quietly bleeding out. Two companies, same industry, completely different stories. Since the merger that created TKO Group Holdings, professional wrestling hasn't just changed hands, it's changed shape entirely. Netflix money, Saudi Arabia money, Paramount mergers, $1 billion buyback. And on the other side, a scrappy independent promotion trying to survive in the shadow of a corporate giant that now owns UFC, WWE, and a piece of the Olympics. So here's the question we're actually answering today. Is AEW closing the gap on WWE, or is the gap turning into a canyon? Stick around, because the numbers tell a story that neither fan base wants to admit. Let's rewind for anyone just joining the story. TKO Group Holdings was formed when Endeavor, the entertainment conglomerate run by Ari Emanuel, merged its UFC business with WWE. Vince McMahon initially held a major stake in board influence, before being pushed out entirely following a string of misconduct allegations. What was left was a leaner, Wall Street-facing combat sports empire, trading publicly, answering to shareholders every quarter instead of to one family patriarch. That single structural shift changed everything about how WWE operates. Every live event, every media deal, every Saudi Arabia partnership now gets scrutinized the same way a hedge fund scrutinizes a merger, through the lens of EBITDA, margins, and shareholder return. And the results, at least on paper, have been staggering. TKO's most recent full-year numbers show total revenue crossing $4.7 billion, with WWE alone pulling in $1.71 billion, a 22% jump year over year. Net income for the whole company swung from a $250 million loss the year before to a $546 million profit. And in the most recent quarter reported, WWE's revenue climbed again, up over $84 million, driven largely by live event bonuses tied to a Saudi-hosted Royal Rumble and new media rights money. This isn't a wrestling company anymore in the way fans grew up understanding it. This is a media and live entertainment machine, and AEW is the one small independent studio trying to survive next door to the new Disney of combat sports. The single biggest swing factor in WWE's growth story is a deal that has nothing to do with wrestling television, as fans knew it for 40 years, the move of Monday Night Raw off of cable and onto Netflix. That deal put WWE's flagship show in front of an audience of hundreds of millions of global subscribers instead of a shrinking cable box audience. It fundamentally changed how WWE gets paid, not by chasing a Nielsen rating for advertisers, but by being a retention tool for the biggest streaming platform on earth. Financially, the results show up directly in the numbers. WWE's media rights and content revenue climbed by tens of millions of dollars quarter over quarter, with the company's own earnings reports crediting higher media rights fees tied specifically to the Netflix and ESPN distribution agreements. WWE also struck a major deal moving its premium live events, including WrestleMania, to ESPN. WrestleMania 42 alone reportedly drew well over 3 million traditional broadcast viewers across its 2 nights. Then there's the Saudi Arabia factor. TKO's leadership has been explicit that events like the Royal Rumble, held under WWE's long-term partnership with the Saudi General Entertainment Authority, are now a meaningful chunk of live event revenue through what the company calls financial incentive packages. In 2026 alone, WWE is scheduled to hold 3 separate events in Saudi Arabia, the most in a single year since that relationship began back in 2018. Add to that consumer products, mobile games, collectibles, and partnerships and marketing revenue that nearly doubled year over year. Every single division is growing at once. But here's the uncomfortable part of this story that TKO's earnings calls don't spend much time on. Actual television ratings, in the classic sense, are down. Nielsen changed its measurement methodology twice in less than a year. First in a way that depressed wrestling numbers, then in a way that inflated them again. Compare that instability to WWE just 5 years ago, when a Monday Night Raw rating was the single cleanest signal of the promotion's health. In other words, WWE's growth isn't really about more people watching wrestling. It's about wrestling becoming a smaller piece of a much bigger, much smarter distribution machine. Now let's flip to the other side of the ledger. All Elite Wrestling, founded by Tony Khan in 2019 as the first real national challenger to WWE in over 2 decades. Here's what's genuinely surprising. By at least one measure, AEW just had its best financial year ever. Because AEW is privately held under the Khan family, exact figures aren't public, but wrestling business analysts have projected the company's 2025 revenue somewhere between $244 and $269 million, a jump of roughly 40 to 50% from the year before. That would translate into an estimated net profit in the range of $60 to $76 million. The engine behind that jump is AEW's new media rights agreement with Warner Bros. Discovery, which went into effect in January 2025. The deal keeps AEW Dynamite on TBS and AEW Collision on TNT, while adding both shows to HBO Max for live streaming, reportedly worth somewhere between $170 and $185 million per year, as part of a 3-year package valued around $555 million total. So on paper, that's a genuine win. But now here's where the story gets complicated, and where the documentary title, How the Merger Changed the Trajectory, really earns its meaning. AEW's weekly television viewership has been under real pressure. Dynamite has posted several ratings drops through the spring of 2026, falling into the low 600,000 viewer range on multiple weeks, with some of its worst demo numbers of the year. A brief surge tied to a surprise, Ronda Rousey appearance at Revolution, faded almost immediately once she disappeared from television. AEW also lost one of its biggest stars, Toni Storm, to an extended absence, which analysts say gutted momentum in the women's division at a moment the company needed stability, not chaos. Tony Khan himself has publicly pushed back on the idea that AEW's audience is shrinking, framing cable viewership as still growing in certain respects, even as year-over-year comparisons show meaningful double-digit percentage declines in key demographics. That gap between the company's public messaging and the raw Nielsen data has become its own recurring storyline in wrestling media. Journalists and analysts increasingly note the disconnect between Khan's optimism and what the numbers actually show. And then there's the uncertainty hanging over AEW's entire broadcast future, Warner Bros. Discovery, AEW's parent broadcast partner, is in the middle of being acquired by Paramount Skydance in a deal worth roughly $110 billion, expected to close by the third quarter of 2026. That's the same Paramount that now holds a major UFC broadcast deal, meaning AEW's business partner and its chief rival's business partner may soon be the exact same company. Khan has publicly said he's not worried, describing strong relationships with WBD leadership on both sides of the corporate split. But industry insiders have reported AEW quietly built contingency plans in case its option year isn't picked up down the line. So, AEW is making more money than ever, while simultaneously watching its weekly audience erode and its long-term broadcast future sit inside a corporate merger it doesn't control. Let's put this side by side, because the surface level story and the underneath the hood story are two very different things. Revenue scale. WWE, backed by TKO, generated over $1.7 billion last year. AEW's entire estimated revenue, at its best year ever, is still less than a fifth of that number. Growth rate. Here AEW actually wins on paper. A 40 to 50% jump in 1 year is a growth rate. WWE, already a mature, billion-dollar business, simply cannot replicate percentage-wise. But growth rate off a small base and growth rate off a billion-dollar base mean very different things to investors. Television audience. WWE's Netflix numbers are difficult to compare directly to traditional ratings because of how Netflix measures viewership. Total hours watched divided by runtime, not a live Nielsen panel. But on traditional cable, both companies are dealing with a shrinking linear TV universe. The difference is WWE has largely exited that shrinking pool by moving to streaming and broadcast network deals, while AEW remains anchored to cable, now facing real erosion. Corporate stability. This might be the single biggest divide. WWE sits inside TKO, a publicly traded company with billions in cash flow, an 8-figure UFC fighter pay investment, a billion-dollar stock buyback program, and diversified revenue from the Olympics-adjacent IMG and on-location segments. AEW sits as a privately held company whose entire broadcast lifeline depends on the outcome of a $100 billion merger it has zero control over. Live events and premium content. WWE's Saudi Arabia partnership alone reportedly generates enormous financial incentive package revenue that dwarfs anything AEW's pay-per-view business produces. Meanwhile, AEW has leaned into pay-per-view depth, with events like Revolution still drawing strong buys, but continues wrestling nearly 50 consecutive premium events without ever headlining with a women's match, a criticism that's followed the company as its women's division has struggled for direction. So if this were a scoreboard, WWE is winning almost every category that involves scale and stability. AEW is winning exactly one category: percentage growth. And even that comes with an asterisk, because a chunk of it is simply the value of a renegotiated TV deal, not new fans discovering the product. Here's the bigger picture underneath all these numbers. TKO didn't just make WWE richer. It made WWE structurally different from every other wrestling promotion on Earth. It's no longer competing purely as a wrestling company. It's a diversified live entertainment and media rights business that happens to have wrestling as one of its core products, sitting alongside UFC, the Olympics through IMG, and global live events hospitality through On Location. That diversification is exactly why TKO's leadership can say competition from other combat sports promotions is not currently seen as a major concern. AEW, by contrast, remains almost entirely dependent on one thing: its relationship with a single broadcast partner. When that partner is thriving and prioritizing wrestling, AEW thrives with it, which is exactly what happened in 2025. But when that partner's corporate structure is in flux, as Warner Bros. Discovery's is right now, mid-merger with Paramount, AEW's future gets tied to decisions made in boardrooms that have nothing to do with wrestling at all. The uncomfortable truth for AEW fans is this: the company's financial best year ever and its ratings' most troubling stretch are happening simultaneously. That's not necessarily contradictory. It just means AEW has built a profitable business on top of a shrinking core audience, propped up by a favorable rights deal that won't renegotiate itself this well forever. The uncomfortable truth for WWE fans, meanwhile, is that growth under TKO doesn't necessarily mean better wrestling television. It means better distribution deals, better financial engineering, and a level of corporate scale that has very little to do with who's actually in the ring on a given Monday night. So, 1 year deeper into the TKO era, WWE isn't just winning the wrestling war. It's stopped playing the same game entirely. It's playing a media conglomerates game, with wrestling as just one product line among many. AEW, meanwhile, is proving something real, that it can turn a profit, that Warner Bros. Discovery still believes in the brand, and that there's still an audience, even a shrinking one, willing to show up every single week for something WWE isn't offering. The real question for the next 12 months isn't who's winning. It's whether AEW can survive as a profitable niche business inside a corporate media merger it doesn't control, while WWE keeps compounding an advantage that started the moment Vince McMahon walked away and TKO's spreadsheets took over. If this breakdown helped you actually understand what's happening behind the curtain in pro wrestling business, not just what happens in the ring, hit subscribe, drop a comment telling us who you think wins the next 12 months, and we'll see you in the next one.